April 2nd for this free online investor-focused event. You'll hear unique perspectives about retirement strategies and investment opportunities from Morningstar analysts and specialists. Register today at morningstar.com/conference.
For Morningstar, I'm Jeremy Glazer. The start of 2016 has been a tumultuous one for stocks, and I'm here with Josh Peters, the editor of our Dividend Investor newsletter, also our director of equity income strategy, to see if it's opening up any opportunities in dividend payers. Josh, thanks for joining me.
Good to be here, Jeremy.
So the beginning of 2016 has been anything but calm. When you look at some of the dividend-paying sectors, have they also been hit by the volatility we've seen in the broad market?
Energy has been. That continues to be an area of some big dividend yields from the big oil companies and especially the midstream energy names, MLPs and whatnot. They're off to a dreadful start, but tremendous volatility. The price of oil going up and down, flying around like it is. For the most part, the rest of the high yield universe has held up pretty well, which is really what you expect in a downturn. So your staples, utilities, REITs, defensive cash flow streams, less susceptibility to really being pinched by a recession if we turn out to have one. Currency is still an issue, certainly for the staples names, but these really dependable names have held up about as well as you'd expect. The drawback is that they're not cheap at this point, and that's different than the downturn pullback we had back in the late summer. You saw utilities actually get pretty cheap for a while, a couple of weeks. Same thing with REITs. It was a good opportunity to add to those positions. The market may have come back even lower now on this latest pullback than it was in September, but these defensive groups, what now everybody wants to own them, they've actually got more expensive.
So does that mean there aren't a lot of opportunities for the types of stocks you like to own?
I like to think of the best time to start on an equity income strategy, a high yield strategy, as when you realize it's right for you and not worry so much about trying to time an entry point. Valuations certainly matter, but what's really important is the decision that you make as an investor as opposed to what's out there in the market. The one point I would make with that, though, is that when you decide on that strategy, you really have to be prepared to stick with it. And I say this a lot. You've got to have that long-term time horizon. Be thinking multiple cycles. Long-term is not 15 minutes as opposed to 15 seconds. It's 15 years. Or who knows how long, but a very long period of time. And as part of that strategy, you want to make sure that the companies that you're buying are consistent with that, even in the tough times. And for example, you've seen a lot of industrial names get a lot cheaper here in the last month or so, to the point where you're finding names like, say, Caterpillar or Cummins,